coronavirus collapsed a year later and how it affected markets. As the anniversary of the coronavirus accident approaches, Jason Hollands of Tilney Investment Management outlines 4 lessons investors can learn from last year. There is an old saying that time flies while having fun. But since we are only a few days left to the first anniversary of the coronavirus accident that started seriously, I'm not convinced that this is true at all. Put your mind aside, and you may remember that the news that a strange new virus emerged in Wuhan, China, spread from Asia to Europe, triggered the coronavirus accident. Stock markets went into a month-long freefall with dips in some indices by 30% within a month. The reality of the emerging reality came to the minds of investors who were quickly pricing in a sharp global recession. By historical standards, this bear market was not remarkably deep. For example, 1929 Wall Street crash saw share prices fall 89%, and the global financial crisis in 2008 fell from peak to 49%, but it certainly survived out for its pace. The crash of 1929 ended 34 months before it hit rock bottom. It took 43 months for the dot-com bubble to burst, and 16 months for stocks to reach their lowest level in the event of the global financial crisis. In contrast, the coronavirus crash was a brutal but short 1-month event as shown in the graph below. The Fed has gone to the rescue. We should thank central banks for putting an end to the market rout by opening the taps to create new money and releasing unprecedented liquidity. The decisive moment that stopped the decline came on March 23rd, when the Federal Reserve promised to make unlimited bond purchases to support smooth market functioning, actively committed to doing whatever it takes to provide the financial markets with abundant liquidity, and the borrowing costs for businesses were incredible. Since the beginning of 2020, the Fed's balance sheet has risen from $4.2 trillion to a staggering $7.4 trillion today, because it replenished financial assets and created new cash in return. This far outweighs the steps the banking system took during the 2008 global financial crisis, when it came to the brink of an abyss. With the knowledge that the Fed and other central banks around the world have invested backing, this has yielded incredible returns in investment markets, despite the ongoing crisis in the real world. As shown in the chart below, since the Fed has put a line on the sand, the S&P index of United States stocks in local currency is 78%. The MSCI World Index 48%, and the MSCI UK All Cap Index of UK stocks are only 37%, all despite common deadlocks and restrictions. This recovery was seen to be truly impressive in this regard, but was also clearly unequal in performance, with huge disparities between technology and online stocks, those that benefit from lockouts, and economically sensitive areas such as energy and finance. So, what are the lessons investors can learn from this? The relationship between investment markets and the real economy is complex. Investment banks and fund managers often devote a lot of energy to economic forecasting. Still, the relationship between stock markets and GDP growth figures is very weak. A bigger impetus for markets is how much money is circulating in the financial system. When interest rates and bond yields are extremely low and large amounts of new money are created, most of them will enter the stock markets as investors seek higher returns and companies can refinance their debt very cheaply. It may seem perverse, but when a crisis prompts central banks to take emergency action, markets become more and more. Conversely, as the real economy recovers and perhaps inflation reboots, a future risk for investors will be any decision central banks take to lower some of these emergency measures, and that will be taken just as badly as grabbing the punch bowl. In the middle of the New Year party, this happened in 2013 when former Fed Chairman Ben Bernanke started a contraction crisis in the markets, arguing that only the Fed could begin to gradually reduce its stimulus program. Keep an eye on the Fed next year. Do not panic while the stock is sliding. Those who hit the panic button during the coronavirus collapse and sold their stock investments made paper losses a reality, could now be kicking themselves if they saw how most markets have performed since then. Sometimes the best course of action during periods of extreme turbulence is to sit tight and do nothing. Even rearranging your portfolio can be risky when prices fluctuate sharply. One day you can lock in losses and then reinvest when prices rise the next day. It can be like trying to change an airplane engine while in flight. When others are selling panic, consider buying shares. In 1986, legendary US investor Warren Buffett referred to two super infectious diseases to which markets are prone. He was talking about fear and greed, not COVID-19, SARS, or swine flu. His answer was simple. We try to be afraid when others are greedy, and greedy when others are afraid. Really smart words. Buying shares as others sell panic and prices go down takes nerves of steel. Still, history shows time and again that bear markets are great opportunities for those with cash ready to invest. Of course, looking to the bottom of a market slide is like trying to catch a falling knife, so a logical approach when markets slide is to feed the money gradually. Last year's story may not be next year's story. The big winners of 2020 were undoubtedly technology and online businesses that have greatly benefited from the crashes, where people work and shop from home, entertain themselves and communicate a lot online. Technological and online posts ballooned in value as the wind blew in their sails. Big tech companies are not moving away and will continue to play an enormous role in our lives, despite increasing scrutiny. But at the same time, if you never think we can escape from a world with eternal lock, at some point the restrictions will decrease and people will start driving more, vacationing, visiting shops and socializing again. Vaccination programs make this a real possibility in the coming months. The lockdowns have created a period of forced savings, which means there is a subdued wall of cash that can rapidly increase consumer spending and allow profits to recover sharply in businesses that survive the crisis. If you, like me, believe that vaccines will deliver this as the year progresses, this should support a rebound in some parts of the market, especially with a tough 2020, so we can see very different trends emerging when compared this year to the fullest. If you make any investment or legal decision, it is advised to consult an expert before making this decision.